how much focus and how much volatility are we going to see in the markets in general? And then I'll ask you about fixed income shortly, ahead of the U.S. election.
Well, listen, I mean, I think it's a very, very important point to reflect on, right? And Francine, this election is very different in a number of ways than the elections that we've had in the past. First of all, the platforms of the two candidates are very, very far apart. But also, I would suggest in this election, we're going to have potentially 3 points of volatility, right? The election itself, which obviously concerns about the way the election is administered, right, factually, so the mail-in ballots versus the in-person voting. Second is the actual outcome, so what actually happens, how close will it be, how clear will it be that one party has, or one person has won or lost, and then the transition of power, right? So how does then the transition go through once the election has been decided? And each one of those could build on each other to have a very volatile period. And so when we look at the markets, obviously the virus and reinfection are an incredibly important part of market volatility going forward. But when we look at a more contained, knowable event, the U.S. election, I think, could be a very, very big source of volatility going forward.
Scott, the other big question, of course, that's, depending on the day impacting fixed income is we're creating so much debt. What does it mean for taxes? What does it mean for the fiscal side of things? Should we really start talking about it or worrying about it? Or do we just look at Japan and say, well, Japan, has been living fine with that much debt for such a long time that it's just not something that investors should worry about right now?
It's a very interesting question. It's a difficult one to answer. So obviously, we're reaching, levels of deficits that are, obviously wartime like in many respects. And the news around the U.S. deficit over the weekend, reaching incredible levels. But, it's interesting because it's a balance, right, in a situation where we have this policy revolution, which we've talked about. And a big part of the policy revolution is effectively the central banks of these countries and the governments working together to implement the policies, right? And so, yes, longer term, obviously, we are concerned about higher borrowing, higher deficits, steeper yield curves, and more inflationary pressure that is associated with that. But I think in the near term, you have this kind of 1-2 combo of policy where you have coordination between the central bank and the government to keep yields where they are, right? So the yield curve control in Japan, or implicit or explicit in the United States, if yields were to get much higher. Even Christine Lagarde talking about the euro more explicitly than the ECB has in some respects in the past, all suggest that the central banks are going to be very keen on keeping financial conditions easy, keeping yields low, or at least not volatile. And so I do think that concerns around borrowing and around deficits are something investors have to pay attention to. I just don't know about it in the next couple of months.
Scott, what does it mean then? Where do you see the best value in fixed income? And when you're looking at treasuries, what are the chances that we actually do get a comprehensive U.S. fiscal package?
Well, I think it's a very good question. So I'll answer the question 2 ways. One is look at the volatility of the U.S. 10-year for a moment. So March 24th, the day that the Fed announced the policy, the U.S. 10-year note was at 70 basis points. I think it's at 70 basis points right now. And yes, there's been some volatility. We've been down to 55. We've been up to 91. But effectively, the policy implementation has really taken the volatility out of the underlying Treasury market, which has been very good for assets like investment-grade credit. We had been very positive on investment-grade credit coming out of the policy announcements because we saw really a very, very powerful dynamic helping the spreads recover. But now as we look going forward, we've shifted that view to high yield from investment grade because we believe high yield, still offers value from an all-in yield perspective and from an applied default perspective, but also, Francine, from a real economic policy helping perspective. We expect to see better fiscal spending, obviously maybe delayed by the election, maybe delayed about political wrangling. But we do expect more policy to be delivered. And therefore, for us, given the kind of the need for yield, the valuations, high yield actually looks very attractive to us.